Here are the total returns for the preferred stocks offered by Strategy. Today, we'll focus on the steady Eddie of the bunch, STRC. This preferred stock currently yields 10.6%, paid monthly, and unlike Bitcoin, it's designed for low volatility, very low volatility. If you're curious to find out where the yield comes from and why the volatility is so low, well, that makes two of us. Let's start with the reason we're here, the income. STRC has only been around since July 2025. So far, the monthly distributions have behaved as promised. We'll ignore the first one because it was based on a partial month. Since then, the range has been 83 cents to 88 cents. There are several ways to calculate the yield, but if we simply take the last distribution of 87.5 cents, multiply it by 12 and divide by today's price of $98.63, we get an annualized yield of 10.6%. These distribution history charts are handy because most websites give you a table that looks like this, and it's impossible to really make out a trend. This is THQ, by the way, a healthcare fund that I hold that yields just under 12%. But when you look at the chart version, any trends or changes are immediately obvious. I use Snowball for distribution charts, and I also use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. The Strategy Incorporated 9% Series A Perpetual Stretch Preferred Stock was issued by MicroStrategy, or to use their new name, Strategy. And Strategy is the largest corporate holder of Bitcoin in the world with roughly 3% of the total supply. They issued this STRC preferred share along with other preferreds for one purpose: to buy more Bitcoin. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. This one sits right in the middle of that. And if you'd like a copy of my portfolio, it's available via Armchair Insider. Link in the description. It's free. For some context, Strategy common stock pays no dividend and is wildly volatile. As I record this, it's down a lot for the year, but over the past 5 years and 10-year periods, it has been spectacular. None of that helps me, though, as an income investor. The 3 other Strategy preferred stocks pay either 8% or 10% of their par value fixed. As market conditions fluctuate, so do the prices of the 3 other preferred shares. They've been around for less than a year, but it's clear that they don't follow the S&P 500 very closely. I quoted a yield earlier of more than 10%, but the yield is variable, so what can you expect? Based on this slide in the Strategy presentation, a rough guide is the yield on the 1-month US Treasury plus about 4.7%. I say roughly because Strategy reserves the right to change the distribution as part of its pricing mechanism, which we'll get to shortly. Broadly speaking, though, it will rise and fall with the yield on the 1-month US Treasury. STRC is designed to be the opposite of the other 3 preferred shares from Strategy. Instead of fixed distributions and a fluctuating price, it pays a variable distribution to help maintain a consistent target price, and the target is $100 a share. It was launched at just under $90 a share to generate some initial demand from early investors, but the price control mechanisms are based on the $100 target. So that initial appreciation should be a one-time thing. Going forward, assuming it works as intended, the price of STRC will remain close to $100. And that's my long-winded way of saying don't expect any significant appreciation over $100. And if Strategy is correct, the flip side is the interesting part for us investors. Don't expect any significant price decline. Let's take a look at how they intend to maintain that $100 price. Between $99 and $101, they do nothing. At or below $99, they increase the distribution to create more demand for the preferred shares. They can also stop selling STRC to reduce the supply of preferred shares. What if the price gets too high? At or above $101, they can do, well, the opposite. They can reduce the distribution And at this point, it's worth noting that per the terms of the offering, they can only reduce the distribution by a maximum of 0.25% per month. So hypothetically, the fastest it could fall from, say, 10% to 9% would be over a period of 4 months. The second way they can put downward pressure on the price is to sell more STRC preferred shares. And they have a third way to push the price down, which is to buy back existing shares at $101. That's another important element of STRC. It's callable or redeemable at $101. Knowing this, investors are incentivized not to pay too much more than $101 because they could potentially lose any premium they pay over that number if the shares were redeemed. Also worth noting that STRC is cumulative, meaning that if distributions were to be halted, they accumulate and then are payable to shareholders upon the resumption of distributions. So the next question is, where does this money or income come from? Strategy's software business doesn't cover it, and Bitcoin doesn't generate income. The short answer is the shareholders of STRC preferred shares. Strategy has the right to issue more shares to pay the STRC distributions. Strategy calls them dividends, but they're not a portion of the company's earnings technically, so I call them distributions. Issuing more stock is referred to as ATM. This ATM differs from the bank ATM where you pull out cash, though it is kind of a cash machine. Instead of automatic teller machine, this ATM stands for at the market. It just means that Strategy sells more STRC preferred shares at the current market price, and that price would be ideally about $100 or even slightly more than $100. Most of that money is used to buy more Bitcoin, which for Strategy is the whole point of issuing STRC. But some of the money raised via ATM is used to pay the distributions. This is where most people, including myself, go, sell new shares to pay the existing shareholders. That sounds a bit dodgy. Now, before we explore the dodgy part, let's get a sense of how much money they need to raise to pay for all these distributions. They're projecting $300 million to pay for the STRC distributions. Then when you add the other preferreds and convertible debt, it comes to $689 million. Now look at how much Strategy has raised so far in 2025. $2.5 billion from STRC alone, and just under $20 billion with a B dollars in total. So for the time being, at least, they have plenty of cash to buy more Bitcoin and pay for the distributions. I took those last two slides from Marc Gerstein's analysis of STRC on Seeking Alpha. If you'd like to learn more about STRC, it's a good read. I use Seeking Alpha to research every income stock or fund. And if you're watching this on or before December 10th, 2025, their Black Friday sale is currently underway. I'll include a link in the description to Marc's analysis of STRC and a link for a free trial and a discount. The same link works for the Black Friday sale or the Armchair discount, whichever is applicable when you watch this. Let's get back to dodgy. Selling new shares to pay existing shareholders is one of the elements of a Ponzi scheme. But by the definition, this is not a Ponzi. First of all, companies and funds raise money via ATM all the time. As part of that process, there is potential to use some of the funds they raise to pay distributions to existing shareholders. However, they generally avoid it because the market sees it as a negative for a few reasons, including diluting shareholder value. So to be clear, Strategy's system of using ATM specifically to fund distributions is outside the norm. Secondly, there's no fraud or misrepresentation. The prospectus outlines how everything works. A Ponzi promotes an investment that doesn't actually exist. And third, there is an actual investment opportunity here. It's that Strategy's ever-increasing Bitcoin holdings will increase in value. So not a Ponzi, but definitely unconventional. And there are, of course, risks. So let's look at those. The obvious risks are that this investment relies on Bitcoin continuing to appreciate, and this in turn causing Strategy stock to appreciate. More specifically, Bitcoin needs to appreciate faster than the cost of servicing these preferred shares, which are mostly in the 8 to 10% yield range. Historically, Bitcoin has grown a lot faster than that. Over the past 13 years, it has grown at 99 cents per year on average, and this 10-year chart versus the S&P 500 gives you a visual representation of the rapid appreciation. Assuming Bitcoin continues to appreciate at more than 10% a year, there are also risks associated with the issuer strategy. First of all, this price stability mechanism is new and untested. Will it create a floor of $97, $95? I'm curious to see how it will perform during a crash. Secondly, is the risk that strategy gets too aggressive with its leverage. Currently, the amount of debt they've taken on is quite moderate, roughly $8 billion compared to a market cap of $57 billion, or the current value of their Bitcoin, about $61 billion. Their website is very transparent, so it's easy to keep track of these numbers. The tax treatment is favorable because according to the 8937 tax form submitted by Strategy, they expect 100% of the distributions to be classified as return of capital. That means no tax due unless or until you sell. The return of capital distributions will lower your cost basis, and then the tax due will be calculated as a capital gain. I've seen some people refer to STRC as Strategy's money market account. Given the risks, I would not use STRC quite that way, meaning if I sold a house and needed to park a large pile of cash somewhere for a few months, I would use a money market account, but not STRC. There are risks. On the other hand, I would consider a small allocation to STRC as a way to generate a yield of almost 5% above short-term treasuries with low volatility and low correlation to the S&P 500. I'm in no rush for two reasons. Number one, the untested price stability mechanism that I mentioned a bit earlier. Secondly, there's no financial incentive to buy it now versus 6 weeks from now or 6 months from now. Initially, there was an incentive when it launched under $90, but now that it has reached its target $100 number, it should make very little difference when you buy it. Even though I don't currently hold STRC, quite a few members of our Armchair Insider Lounge community have already purchased it, so STRC will continue to be a topic of discussion. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, click here for reviews focused on my top 10 holdings. That wraps it up for this look at STRC. More Armchair Income coming soon.